property, plant and equipment, depreciation, disposal, and impairment. So we are going to first discuss an overview, composite depreciation and component, basic methods, disposal, disclosure, depletion, and finally impairment of property, plant and equipment. So let's get started. First of all, why do we need to charge depreciation? What is the reason? What is depreciation? First of all, when you purchase an asset that will last for 5 years and you pay $1 million, let's say, and by the end of the 5th year, let's say it becomes zero, it has no value, worthless. So if you charge full 1 million expense at the end of 5th year, that is terrible for the year 5. You cannot charge whole of the cost of the asset on the last year when it is gone. So rationally, we can allocate the cost of this asset over its estimated useful life. That is what depreciation is all about. So what we do in depreciation, we systematically allocate the cost of the asset over their useful life. So this is a perfect application of matching principle. Like we have earned some money using this asset. So the revenue generated by this asset is matched with the cost of the asset, which is spread over the life of the asset. So this is a very important application of matching principle. So depreciation can be handled through different methods, which we'll discuss in the coming slides. Straight line method, declining balance, double declining balance method, units of production method, and depending upon the asset type and the company's accounting policy. So we'll discuss all. Let us first discuss types of depreciations. First, we have physical depreciation. This means when the asset gets worn out with the usage of time, of course. That's called the natural wear and tear. So this means natural wear and tear of an asset due to usage over time. For example, a machine might become less efficient after several years of operation. Then second type of depreciation is functional depreciation. Functional depreciation occurs when an asset becomes obsolete or inefficient because some new technology has come and the older one is not that much in an efficient form. A typical example is mobile phone. Consider a phone purchased 5 years ago. With the current version of the phones available, you would see that because of new technology, the older assets, they do not perform well. Take an example. Suppose a company uses a machine that cost $10,000, right? So after 5 years, a new model is available for $12,000, which is more efficient. It is more cost effective and it takes less effort to operate. So the old machine has now become functionally depreciated because a better alternative has come in the market. Let us now discuss some basic definitions. First, we have salvage value. Salvage value is basically the expected value of an asset at the end of its life or its useful life. Consider a company purchases an equipment for, let's say, $50,000 and it is expected to last 10 years. So the estimated salvage value, let's say, if it's $5,000, right? That means $50,000 is the cost, $5,000 is the estimated scrap value or salvage value. This balance, the net figure 45, this is what you call the total depreciable amount, which we will depreciate over 10 years of the life of the asset, right? So salvage value means the value at which the asset will be disposed at the end of its useful life. Next, we have the estimated useful life. This is the period, just in the previous example, 10 years. This is the period over which the asset will be used and it will be depreciated. Like the previous example, $45,000 is the depreciable base and we want to spread it equally over the 10 years. So it means annual depreciation will charge is $4,500. This is the estimated useful life for which the asset will be in service. Then what about partial year depreciation? If a company purchases an asset, let's say on 1st of July, year 1, not on 1st of January. So half year's worth of depreciation would be taken for the first year. So if you are, let's say, using the straight line method, which we'll discuss what this method is. So we will take, for this example, we have $4,500 is the annual depreciation since we have used it for 6 months only. So 6 upon 12 of the annual depreciation. So that means we'll charge 20 to 50 depreciation for the first year, the first 6 months depreciation. So your CPA exam will frequently ask you about the partial year depreciation calculation. So this is the way you do. You take the number of months for which the asset was in service over 12 times the annual depreciation, and that's you get the answer. Composite depreciation and component depreciation. First, component depreciation means, let's say your asset is so big and large, and each part is significant in amount, right? So each part of property, plant and equipment, in this case, is depreciated separately. This method is used when a part of the asset itself has significant in value, like this part A, B, C, D. Talk about aeroplane. Engine are significantly valuable, so they are depreciated separately. Like for example, if you have got a building and let's say the heating system is worth $50,000, so this system of heating is depreciated separately from the rest of the building. So this is what you mean by component depreciation. What is composite depreciation? Composite depreciation basically is a simpler way. It simply averages the useful lives of many assets, treating those assets like we have many dissimilar assets. Right? So simply considering them as a single asset, treat them as a single one group and then depreciating them together. So this is simpler. This makes record keeping simpler. Like let's say we have 10 different machines. Some are having useful life of 5 years, some 7, some 10 years. So we may average useful life of these machines to be, let's say, 8 years, and then we depreciate the entire group over this period of time. So this is what you call the composite or group depreciation. So within this, we have a subtopic, asset retirement. So when an asset from the group is sold or retired, let's say we purchase for the initial figure of, let's say, $50,000, and let's say the average life of the assets in this group is 7 years, and this asset was sold, let's say, on 5th year, right? So it has an original cost of $50,000. It's being sold for $10,000. The difference, $40,000, apparently is a loss. Cost versus, this is what we do in a composite group or group depreciation, in which we simply compare the cost versus the disposal value. The difference, whether a gain or loss, goes as a credit or as a debit to accumulated depreciation. Please, I'm going to repeat. In composite or group depreciation, if any asset is sold, the difference between the cost and the salvage value, the disposal value, this difference is credited or debited to the accumulated depreciation account, right? So maybe it is possible that the asset that would originally had a cost of 50,000 was sold for 60, right? In that case, this is 10,000 gain. Here is 40,000 loss. So any gain and loss is debited or credited to accumulated depreciation and not to the income statement. Depreciation method. So in composite or component depreciation, both, we can use various methods like straight line depreciation method or maybe the double declining balance method, sum of your digit method, whatever. Like for example, if we have selected the straight line method to depreciate our assets in the group depreciation method. So if the total size of the pool of this asset is $500,000, and let's say we have selected average useful life to be 10 years, then the annual depreciation will be $50,000. A schedule of machinery owned by Leicester Manufacturing Group Company is presented below. We have 3 machines ABC with these costs, with these estimated salvage values and estimated life in years. Leicester computes depreciation on straight line method. Depreciate the machinery using the composite depreciation. Alright, let us first calculate the average composite life. For this, we do total assets less estimated salvage value divided by the estimated life in years. That gives you annual depreciation on this machine to be $25,000. 200,000 less 20,000 divided by 15 gives you annual depreciation 12. 40 less nil divided by 5 gives you 8,000. So the total depreciation is $45,000. So if you calculate the depreciable base, 550 less 50, 200 less 20, and 40 less nil, let me show you in the next slide. The net result of these is 720, depreciable base or depreciable cost, right? This depreciable cost divided by 45,000 annual depreciation give you the average life of the composite group of assets to be 16 years. So now we got the depreciable cost and the average life. So you simply take $720,000 upon 16, you get 45 cents, the depreciation figure for the year. Now assume that the Leicester company sells machine A in 10 years for $260,000. Because the loss on disposal is not recognized, accumulated depreciation must be reduced or debited. We discussed that earlier. In composite or in group depreciation, if any asset is sold, any gain and loss goes to accumulated depreciation. Like in this case, machine A that we are selling, it has a cost of 550, right? Being sold for 260. So we remove the cost by crediting 550. We receive cash 260. The difference goes to accumulated depreciation. Now we're going to discuss different depreciation methods. The key point to remember is that whichever method you use, that method should help you match the cost of the asset with its revenue over time. So this means you need to spread the cost of the asset over its useful life. So first we're going to discuss straight line method. Straight line method is also called equal installment method because the depreciation charge each year is the same. The formula we use is cost of the asset less salvage value over estimated useful life. Consider you have an asset with the cost of $10,000 with the estimated salvage value of $1,000, and let's say the estimated life is 5 years. So that means the depreciation expense each year would be $1,800. Here's an illustration. Cost is $11,000, salvage value $1,000, and estimated life 5. So you do the same. $2,000 will be charged every year. If the asset was acquired within the year instead of at the beginning of the year, a partial depreciation expense is taken in the first year. Let's say you acquired the asset on 1st of July, year 1. So the annual depreciation is 2,000. You will do 2,000 times 6 by 12. So the first year depreciation will be $1,000. Next we have sum of the year's digits depreciation. I'm sure you would have done it in your earlier accounting studies. This method accelerates depreciation, which means more depreciation in the early year and less later. Let us discuss how is it done. First, we calculate the sum of the year's digits. Let's say if the asset that is expected to last 5 years, so we add the digits of the life 1, 2, 3, 4, and 5. If we add all these, 15. So sum of the year's digit is 15. Taking the same number, cost to be 10,000 as the previous example, salvage value 1,000, and number of life of the asset, remaining life of the asset 5 by 15. So this would be the fraction in the first year, second year, third year, 2 by 15, and 1 by 15 in the last year. So as you can see, the bulk gets depreciated in the first year, 5 by 15 of depreciable base, then 4 by 15 next year, then 3 by 15. So the depreciation charge is higher in the early period. So if you calculate the number, it's going to be 3,000. There's another quick way to find the sum of the year's digits. Simply put the life of the asset, like in the example 5, into 5 plus 1 over 2. So if you simplify, it's 30 by 2, 15. So instead of just adding 1 plus 2 plus 3 plus 4 plus 5, you can simply calculate the sum of the year's digits directly using this formula. Let's do an example. Assume that an asset cost 11,000, has a salvage value 1,000, and has a estimated useful life of 4 years. Calculate the amount of depreciation expense for each of the 4 years of the asset's useful life. Fairly straightforward question. First, calculate the depreciable base, that is cost less salvage value, 10,000. Sum of the year's digits, 1 plus 2 plus 3 plus 4 is equal to 10. Alternatively, you can apply this formula for quick calculation, and the estimated life is 4. 4 into 4 plus 1, 5 over 2. So you get simply 10. So you get the same number. This is the sum of the year's digits. So the first year depreciation will be 4 by 10 of 10,000. Second year 3 by 10, 2 by 10, 1 by 10. So if you calculate the all depreciation, it gets equal to the depreciable base. Next we have units of production or productive output depreciation method. This method basically relates your depreciation expense to how much an asset produces. So that's why it's called unit of production method. So basically it uses a rate per unit or rate per machine hour. Let me apply this. Let's say we have an asset with the cost of $10,000, same numbers we're using repeatedly, with the salvage value of $1,000, right? Let's say it can produce a total of 5,000 units over its life. So then 10,000 less 1,000 upon 5,000, that's going to be 9,005. So $1.8 per unit or per hour, whatever the driver is, right? So once we have calculated the rate, next is to see how many units or hours were used in the first year. Like let's say in the first year we use 1,000 hours or 1,000 units, multiply it with the rate, and you get the depreciation expense. So as simple as that. Next, we have declining balance depreciation. This is an accelerated depreciation method, which means most of the depreciation charged in the earlier years, and as we proceed, the depreciation expense is lower in the later years. So this is the formula we use. Please note, in this formula, we do not take the salvage value. This method ignores salvage value in your annual depreciation calculation, right? So what we take the cost. Like in the first year, the cost is $10,000. There is no depreciation so far. 1 upon n means, let's say it will last 5 years. So 1 by 5 times 2 times 10,000. If you calculate, this is going to be the first year depreciation. So what about the second year? In second year, you use the same formula, 2 into 1 over 5. But this time, cost stays the same. But now we have depreciation 4,000 in accumulated depreciation account, right? So when you calculate this now, it is $2,400. So this is the second year depreciation. This is the first year. Now let us see what is the depreciation in the third year. So this is the depreciation expense for year 1, 2. Let us calculate for year 3. So for year 3, same, 2 into 1 over 5 times cost stays the same. And accumulated depreciation is 2,400 plus 4,000, that is 6,600, right? And then that's what we get, 1,440. This is the depreciation for the third year. So what you see is the depreciation is gradually declining as we proceed. In the first year, depreciation is the highest, 2,400, 1,440, and as we go on for year 3, 4, and 5, the depreciation expense will be even lesser. An asset costing 10,000 with a salvage value of 2,000 has an estimated useful life of 10 years. Using the double declining balance method, calculate the depreciation expense for each of the year of the asset's useful life. So here we go. How did we get this 20%? Just look at the formula. See, this part represents percentage. If you just calculate this, 2 times 1 over 10 times 100. So effectively, it gives you the depreciation percentage. Like in our example, it was 2 into 1 upon 5 times 100. So in our example, it was 40%. And it rightly so, 40,000% of 10,000. Depreciation was 4,000 in year 1. Then next year, 10,000 less 4, 6,000. 6,000 is 40%, 2,400. And then the third year, 40% of the net book value, that is 10,000 less 4 less 2,400, that is 4,400. And that gives you 1,440. So this is the depreciation for the first year, second year, third year. This goes exactly the same way here. First year depreciation, 2,000. Next year depreciation, 10 less to 8, 8,000 is 20%. Then third year, 8,000 less 1,600. So your net book value is decreasing every year. 10 less 2, 8 less 1,600, 64 less 20. So you keep on charging this percentage on the net book value. And please remember, your depreciation charge for the last year should be the balancing figure. Let me tell you, if you calculate 20% of 2098, it's 419.6. We can't charge this depreciation, because if we do, then the net book value will fall below the amount that we are supposed to consider, 2,000, right? So that's why we will charge the balancing amount. If you add all these, it will total to $8,000. So because we want our book value at the end of the life of the asset to be $2,000. So if you add, you will get exact 8,000. So here the balance would be 2,000. Partial year depreciation means when an asset is used for only few months of the year, the depreciation is calculated for the months used. Like you purchase an asset on 1st of July, year 1. So you will charge depreciation only for 6 months till the end of the year, right? Then some companies, they follow some specific rules for assets bought or sold during the year. This is called half-year convention. Half-year convention means half year of depreciation is taken both in the year of acquisition and the year of disposal. Like if you purchase an asset for $10,000, on which you will charge 2,000 depreciation every year. So you will charge 1,000 depreciation in the year of purchase and 1,000 in the year of sale. Other than half-year convention, companies may have some alternative policies, like maybe no depreciation in the year of purchase, full depreciation in the year of sale, or full depreciation in the year of purchase and no depreciation in the year of sale. So you need to be careful while you're reading the question which policy company uses for depreciation. Now we have assets disposal. First case, sale of an asset during its useful life. So we are selling an asset while it was in service. So consider some example. We sold an asset for $5,000. So 5,000 is debited. The asset had an original cost of 10,000. So we remove the cost of the asset from the books. Accumulated depreciation charge so far on this asset is $6,000. So you can see 5 plus 6, 11, less 10. So there is a shortfall on the credit side of the entry. This is a gain. This is a gain. Difference is gain on disposal. Gain comes on the credit side. Let's say change some numbers. Let's say if cash received was 4,000 only. In that case, there is no gain loss. Cash received is 4, accumulated is 6, 4 plus 6, 10 plus 10. So in other words, you have sold an asset at its net book value. But considering if you receive cash just $2,000, whereas the asset had an original cost of $10,000, accumulated depreciation 6,000, so you can see the net book value is 10 less 6, 4,000. So you sold an asset with a book value 4 for 2,000. So this 2,000 would be the loss on disposal on this, and there is no gain at all here. So be careful to compare the net book value versus the disposal proceeds. So if net book value is more than disposal proceeds, it's a loss. If net book value is less than the amount you receive, then it's a gain. It's fairly straightforward. Next, we have a write-off of a fully depreciated asset. When you have an asset that has been fully depreciated, the journal entry we make to remove this from the books of accounts, we debit the depreciation and credit the asset, remove it from the books of accounts. In the third case, total and permanent impairment means assets that are impaired permanently. The entries we debit accumulated depreciation. Let's say we have an asset with a cost of $20,000. We credit the cost. Accumulated depreciation so far is $10,000. So the difference clearly 10,000 is the loss due to impairment. Then we have disclosures. So when you're preparing financial statements, you need to disclose certain items related to depreciation. First, depreciation expense for the period means the total depreciation for the current period needs to be reported. Balance of major classes of depreciable assets. Yes, you should show the balance. Of course, this is part of notes. So you need to show the balance of major categories of your depreciable assets, like buildings, equipments. So you can either show them by their nature, mean what type of assets they are, or maybe you can report them by function, means how they are used in the business. Then the third disclosure, accumulated depreciation allowances, means the total accumulated depreciation for each class of the asset or in total for all assets. I'm sure being a professional accountant, you would know I'm talking about the depreciation schedule. And finally, what is the method of depreciation used? You need to report which method has been used, straight line, double declining, so on and so forth. Next, we have depletion. What is depletion? It's a kind of depreciation, but this is used to allocate the cost of natural resources like maybe an oil rig, gas from the earth's surface, timber, and certain minerals that are extracted from the earth's surface. So let us discuss some key definitions related to depletion. First, the purchase cost. This is the cost that is required to buy the land or maybe prepare the land for extracting resources. Let's say you have purchased a piece of land and you will extract certain minerals from this piece of land. So amount you paid, let's say you paid $1 million, right? Now you spend some money on drilling, let's say $0.5 million. You build tunnels so that access the resources, maybe you spend $0.5 million again, so it's total of $2 million. So basically the cost to acquire land and prepare the land for extracting resources. Next, we have the residual value. This residual value is the same as salvage value we discussed previously. So basically this is an estimated value of the land after you have extracted all the resources, considering the total amount we consider here, $2 million. You extracted everything what was there, right? So now this piece of land, after it has exhausted all whatever was inside, so maybe it's worth now, let's say $400,000. This is the residual value. Depletion base is same as the depreciable base we discussed in the previous areas of various assets, property, plant and equipment. So basically this is the amount we discussed here, $2 million less any residual value, let's say $400,000, so it's $1.6 million is the depletion base, which is same as the depreciable base. Then we have methods of depletion. First is the cost depletion. This method is permissible under the US GAAP, and it is the same that we discussed a little while ago, called the units of output method. So what we do, we take the cost less the salvage value divided by the estimated recoverable units, right? So this way we'll be able to establish it like we took in these numbers: 2 million less $400,000, 1.6 million divided by 1 million kgs, let's say. So that gives you the rate of $1.6 per kg, right? So the number of kilograms you extract, like for a certain year we extracted 2,000 kilograms. So the depletion would be 2,000 times 1.6, that is $3,200. That's the answer. Then we have percentage depletion. This is not acceptable for US GAAP. Tax only. This method is used for tax purposes to calculate the depletion on the natural resources like we talked about, gas, oil, or minerals. Okay, let us say your company makes a sale of $1 million from selling oil, and tax rate allows a percentage depletion of 15%. So 15% of 1 million means your depletion deduction would be $150,000. Now the question that arises, that can this deduction, 150,000, can it exceed cost depletion? That's the question we need to answer. The answer is yes. Let's say your cost to extract is $120,000 and your percentage depletion deduction of 150,000 exceeds your cost by $30,000. Fine. So what is the maximum upper ceiling? Cap. What is the cap? To what extent can your percentage depletion exceed the cost depletion? So there is a specific rule to it. Please listen to me very carefully. The deduction is limited to 50% of your net income generated from the resource before the depletion loss. Let's say if your company's net income, that clears this up. Let's say if your company's net income is $400,000 before depletion deduction, you can only deduct up to 50% of this amount, that is $200,000. Whereas in our example, our depletion percentage deduction was $150,000. So that means fine, it is within the upper limit. So this 150,000 amount is fine. So you can take this full deduction because it is less than the 200,000 limit. So the key point here to note is that the percentage depletion is a tax benefit that allows a company to deduct a fixed percentage of revenue, like 50% of 400,000. This is the maximum ceiling, right? But your percentage depletion should not be more than this. Let's say if it is more than this, let's say if it's $230,000, then this is impermissible. You will take this $200,000 as percentage depletion. Calculation of depletion for the period. This is how we calculate depletion. Unit depletion rate, which is calculated using this formula which we discussed in the previous slide. Unit depletion rate is the depletion base divided by the estimated recoverable units. So you use this rate. Let's say our depreciable base is $900,000. And what is depreciable base? Let me show you here. Cost to purchase property. Let's say we purchased $500,000. We paid $200,000 for the development cost to prepare the land for extraction, and then we paid an additional $300,000 for estimated restoration cost. So that gives you 1 million. Of this 1 million, $100,000 is the residual value, less residual value of land after the resources like mineral oil have been extracted. So cost to purchase the property, development cost to prepare the land for extraction, and estimated restoration cost. 1 million less salvage value, 900,000. This is the depletion base, and assuming 100,000 units would be recovered. So the rate we have is $9, right? So unit depletion rate is $9. Let's say for a particular year we extract, let's say 500 units. So the depletion for that period would be simply $4,500. Next we have recognition of depletion. Let's say if all units have been extracted and sold, then the depletion is added to the cost of goods sold, of course. All have been sold, so all the expense has been charged against the revenue. So if all extracted units are sold, the depletion is added to the cost of goods sold. But if not all units are sold, let's say you have extracted 100 tons, right? Of these 100, you have sold 80. So these 80 tons of extraction goes to CGS, it is expense, and remaining 20 will be reported to the inventory. In year 1, Happy Mine Corporation purchased a mineral mine for $3.4 million with removable ore estimated by Geological Service at 4 million tons. The property has an estimated value of $200,000 after the ore has been extracted. The company incurred $800,000 of development cost preparing the mine for production. During year 1, 1.4 million tons were removed and 3,750 tons were sold. Calculate the depletion base for the mineral mine. For this, we need to first take the cost of land, which is 3.4 million, plus development cost. Development cost is given as $800,000, plus any restoration cost. There is no restoration cost, and from this total we deduct the residual value, and that is given as $200,000. So simply take these numbers, 3.4 million plus 0.8, that is 4.2 less 2. So it means the total depletion base would be $4 million. It's a very straightforward calculation. This plus this less this. So that's the answer to the first question. Calculate the depletion base for the mineral mine. That's it, $4 million. Now let's say if we have to calculate the rate, depletion rate, it says there are 4 million tons of ore available. So that means $4 million depletion base, 4 million tons. So that means the rate, depletion rate is $1 per ton. Calculate the amount of depletion the mine should record for year 1. So during year 1, 400,000 tons were removed, and the rate, depletion rate is 1. So it's 400,000 times 1. So it's simple, $400,000. That is the answer to part 2. Depletion rate times units extracted, that's the answer. Last part says determine the amount of depletion the mine should include in the cost of goods sold for year 1. Since remember 400,000 were extracted, of this 375,000 were sold. So this times $1, $375,000 goes to CGS, and remaining 25,000 tons times $1, $25,000, this goes to part of your closing stock. So this is the figure that goes to CGS. See, 1 times this, and remaining 25,000 goes to closing stock. Next we have impairment of property, plant and equipment. So if the asset that we are currently using, or maybe we intend to dispose, we need to review whether the carrying amount of these assets are still recoverable or not. Some of them may have impaired over time. So we need to conduct reviews, not regularly as per the US GAAP. GAAP says that when there are events or changes in circumstances suggesting that whatever we are carrying in the books as the book value of the assets, those book value may not be recoverable. So in such a situation we have to conduct an impairment test, and that's what we're going to do now. Test of recoverability. Let's say we have an asset that will last 4 years, right? And it will generate some cash in these 4 years, right? Including its disposal proceeds. If we add up all the cash flows associated with this asset, let's say it comes out to be 100,000. Just adding these cash flows without discounting. This is called the undiscounted future cash flows. We have simply added them up, right? You compare these undiscounted future cash flows with the book value of the asset, or the carrying value, which we know, which is the original historical cost minus accumulated depreciation. Now, if your book value or carrying value is $150,000, whereas the sum of the future undiscounted cash flows is 100, that clearly is a sign that your asset has been impaired, because the book value is more, undiscounted future cash flows are less. Conversely speaking, if your book value or the carrying value is, let's say, $80,000, but the undiscounted future cash flows are $100,000 more than the book value, then there is no impairment, we do nothing. So let us see it in detail through a proper flow chart. In the first case, our undiscounted future cash flows $100,000 and they are more than the net carrying value. Let's say carrying value is $80,000. So clearly your undiscounted future cash flows are more, carrying value is less. So it means the net figure is positive, plus 20,000. So that means there's no impairment, we do nothing. Now in this case, if your undiscounted future cash flows, sum of the undiscounted future cash flows is $100,000 and carrying value of the asset is, let's say, $130,000. Clearly your undiscounted future cash flows are less, carrying value is more, so the net result 100 less 130 is negative. That tells us that there is an impairment. Impairment has occurred. What is the amount of impairment? That's what we're going to discuss. Now there are two circumstances. One, the assets held for disposal. In this case, what is the impairment loss? This is how it's calculated. Your fair value of the asset, let's say, is $90,000. Or let's say, if fair value isn't available, the present value of the future net cash of this asset, 90,000. Either of these, either fair value or the present value of future net cash flows. It's 90. Carrying value is 130. See, the difference is 40. This is the impairment loss. To this we add the cost of disposal, let's say $10,000. So the total impairment loss we charge is $50,000. This loss writes down the asset. No depreciation is taken for it. If the value goes up, if the fair value or the present value future cash flows, if they subsequently go up, restoration is permitted. You can reverse the loss. Now in the second situation, the asset is held for use. In that case, same numbers, let's say, 90,000 is either the fair value of the asset or the present value of the future net cash flows, less the net carrying amount, that is 130 in our example. So that is 40,000. This $40,000 is the impairment loss. We write down the asset by this amount. Now the new cost would be 40, the reduction 130 less 40, that is $90,000. So your new base of the asset is 90,000. So this is the new base. So we have written down the asset to its new fair value. So we are going to depreciate this 90,000 now in the future. And please remember, restoration not permitted means if the asset value, fair value, the PV of cash flows goes up, the loss that has been charged, it cannot be reversed. Reversal isn't allowed. Next, we have reporting the impairment loss. How do we report it on our financial statement? So the loss that you've charged, it is shown as a part of your income from continuing operations. For example, we have a machine that has a carrying value $50,000, book value, carrying value is 50, but the fair value is only $30,000. So clearly there is an impairment, and this $20,000 impairment we would recognize in the income from continuing operations. And your US GAAP is very explicit in this regard, that if subsequently, once you have written off this loss, you have recognized this loss, subsequently if the asset values goes up, you cannot reverse, you cannot restore this previously recognized impairment loss. And you can do only in one case, we discussed, if the asset is being held for disposal. But if the asset is underused, then you cannot reverse the loss that is charged. Important point, it is important to remember the following rules when performing your calculations. Determining the impairment, use undiscounted future net cash flows as we discussed a little while ago. Like for example, if your machine is expected to generate $50,000 in the future and its carrying value is $55,000, that means impairment has occurred because your undiscounted future cash flows are less than the carrying amount, right? And second part is amount of impairment. Use fair value or discounted PV future net cash flows. Means, let's say if after determining that there is an impairment, if the fair value isn't available, but the present value of future cash flows is $30,000, we will take this as a value for this to calculate the impairment loss. We'll take this $30,000, the present value of the future cash flows, and we will compare it with the carrying value $55,000. In this case, the loss would be $25,000.